Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, July 11th, 2023. Welcome back to the podcast, George.
Great to be back on. It's been a while.
It has been a while. It's been actually far too long. But I guess that's what happens when it's summer and there's a lot going on. So, so given that it's been, a while, and also given that, so far this year, I'd argue that the market and the economy really has defied many participants' expectations, yours included. Given that we've also started the second half of the year, why don't we start today's episode with a quick recap of the year so far across both the economy and financial markets?
I'll do my best, and there's a lot to cover, obviously, considering the sort of first half of the year that we had. I'll zoom out and really focus in on the big picture, global macro, because I think that really set the stage, and then go back and zoom in on the U.S. But as you recall, and those in the markets will remember, Q1 and just the beginning of 2023 started off with great expectations. We had the combo of China reopening, Europe having gone through a mild winter, which should have helped reignite global growth. Overall, initially, those animal spirits and just that kind of backdrop gave us some strong tailwinds, which helped risk assets come out roaring out of the gates at the beginning of the year, where the beginning January was one of the strongest months for many asset classes, especially for credit. However, as the kind of quarter and the year progressed, especially on the macro front, global macro, that is, that kind of great reopening really turned out to be less robust. Most of the euphoria did peak pretty early on, at least for Q1 and in the month of January and early February. Central banks overall, the Fed kept tightening and sounded hawkish. Really nothing new there. There was, as you'll recall and remember, a lot of concerns that perhaps maybe Bank of Japan was going to change their yield curve control sooner, and that led to positioning moves in the marketplace. And I'll go into that more later. U.S. data again started the year kind of like where we are now, where it's bifurcated between the service sector and the jobs market being more resilient, but even there showing signs of weakness and starting to kind of roll over a little bit. But manufacturing has persistently, like for one of the longest stretches in time, manufacturing and all the indicators that go along with it, the ISMs, PMIs, all suggesting weakness, and also that plus the yield curve, hinting at a recession, which has been a fear that many of us have had, or concern, I should say, since late last year. All the way up until early March, even while we're that week where the regional bank issue started, Chair Powell was testifying actually that week of early March, where till this day, that still marks the high watermark on the SOFR curve, where rates were making a run towards 6% on terminal rates, and then the regional turmoil really took place, right? So I think that Q1 backdrop was so critical to how it influenced both policymakers, forecasters like myself, investors more broadly. Really, I think had a lasting impact on what sort of lingering issues would continue in the financial system and the economy. If you remember, it was not just an event; it was a process. We had rate vol that was unleashed like I've never seen before at the end of Q1, Q2, which I know you felt it as well. The 2-year went from basically 5% down to like 3.6, with multiples, 5 standard deviation moves every other day, with like 20 basis point type moves. That rate vol in certain option structures almost surpassed or met or surpassed what we saw during the financial crisis. Speaking of the moves, we have the MOVE index, which is a broader kind of bond market of vol metric, like the VIX. That was like the most volatile since COVID shock. So it really had a profound impact, I think, on a lot of us, especially me. The mortgage market was also in the crosshairs, but the spreads in that market really only peaked in the days heading into the FDIC sales, which were on the back of, again, this regional banking turmoil. And meanwhile, stocks were pretty sanguine throughout that whole period. I mean, they did go down initially. They were trading in a range between 3,800, 4,200. Didn't really look like as if they were going to change direction. And then we had this, later breakout in Q2 once a lot of this concern around the banks as well as the debt ceiling got behind us. But nonetheless, I mean, stocks didn't look like they were going to go anywhere. And then there was, Fed actions, which helped at least address a lot of these liquidity concerns in the banking system with the bank term funding program being put in place, the discount window being used, all helped alleviate, bank pressures. And even throughout that period, credit spreads had like these brief episodes of widening, but they wouldn't last. And like they would just come ratcheting back in. And you saw, pretty decent move in IG, and then eventually high yield even caught a bid and has continued to perform. So like, it was an amazing, like setup. And then we still had to deal with the debt ceiling, the concerns around, the debt ceiling and actual default, which of course we've now moved beyond that. But even post fact, the associated issues with all this issuance of T-bills, I'm sure I've overlooked something, but in retrospect, there's like 1, 2, 3 punch of the banking crisis, concerns around like changes in global monetary policy and the debt ceiling, and like for us, which really hits home, Bank of Japan not changing policy, probably hurt a lot of macro investors. And then that was followed by the regional banking issues, which stopped out. In hindsight, looking through positioning data, a lot of shorts in the rates market, and stocks climbed the wall of worry post debt ceiling. I think that sort of backdrop. It's I mean that's like one for the history books for sure, and has left many macro and active investors with some of the lowest conviction that I can sense in years. And and given all this position shuffling, I think it's been that sort of backdrop of underinvested investors, short, a lot of volatility that kind of led us to this point now where markets look more sanguine. The economy did perform better, but looks like the markets have now overshot, especially on the risk side. Meanwhile, the bond market's starting to catch up that the fact the Fed's not done yet either. So an amazing first half, and I think it's going to really set us up for an interesting second half as well.
Wow, I do not think I realized how big of a question that was. And also I think I forgot half of that stuff, probably just via necessity because it was so traumatic at the time. Um,
I
so
hear you.
yeah, very, very comprehensive background. Thank you. So that sets us up for the next question, which is obviously what do you expect for the second half? It's pretty remarkable as you highlighted in a number of different ways, pretty remarkable first half of the year, which makes me wonder if that continues or if things kind of mellow out. Obviously, there's still or many are still expecting a recession in the second half of the year. Those expectations have been sort of dashed thus far. I did notice that you recently changed your rates forecast, presumably in response to this what's been pretty good, even considering the most recent payroll report, but pretty good employment data. Although many would argue that that is a more backward-looking indicator. But also the Fed has just stuck to this this hawkish rhetoric. I had perhaps naively thought that as they raised rates, they might kind of dial it back a little and kind of focus on keeping rates higher for longer, but it seems like they're hell bent on a couple more hikes here. So I guess again the question to you is what does the second half of the year have in store for us?
Yeah, no, let's just focus on the rates part, which is near and dear to us, and think through how that's going to translate to other asset classes more broadly. I do think, as you can kind of tell, that this general market move in the first half feels like it was positioning driven and a huge catch up and then a chase, and probably has overextended, especially in risk assets. And so perhaps we've pulled forward a lot of the potential upside. We shall see, especially if we get a further normalization in rates, and in particular in the belly of the curve. But in many ways, like you have to kind of go back still to the setup that we were dealt with, which is in many ways the regional bank issue reduced some of the Fed hawkishness, because if you go back and recall, like the Fed was concerned, and I think rightly so, because I think we still have issues down the road, which we can get to in our last question. But I do think that perhaps they skipped in June because they want to see the totality of all their hikes, as well as the lingering problems in the banking system, and the potential for further credit tightening or a credit crunch from what took place. Perhaps if we never got the regional bank issues early on in Q1, the Fed maybe would have been done by now. They would have hiked in June, or maybe ratcheted up higher. I mean, even in March, when Chair Powell was speaking before the regional bank issues, like he was hinting at perhaps they would go back to doing 50 basis point hikes again, right? Moving from 25 back up to 50. They could have been ostensibly done. And here we are, this is dragged out, which has made it much more challenging for fixed income investors. I do think that that runs the risk of the Fed is now hiking into a slowdown at a minimum, potentially a recession, and that could be a policy error in hindsight. We shall see. Um, we are getting to the low points in inflation, especially on the headline. So the base effects, those disinflationary base effects, are probably most helpful throughout the summer period. But then we get into the winter, that those numbers turn around unless housing were to continue, or housing rental inflation, I should say, would start to come down on a little bit lower. And if used car prices come in lower, then maybe we'll get some help on the core side. But the one thing that we're obviously noticing is that it's easier to cut inflation from 8 to 4%, but it's going to be much harder to go from 4 to 2, which is the Fed's mandate. Meanwhile, that does raise the issues of stagflation and maybe low growth and higher inflation than the Fed really wants, leaving the Fed with really bad options, like not hiking, or having to really force an even bigger recession to kill it finally. And so, my view up until this point on the rate side was, as you could tell from my answers so far, and in my work in the recent months, my views were really heavily influenced by what took place with the regional bank issue early on. We were holding what I call like two views in tandem. The first view that data would eventually slow, and it has been slowing outside the jobs market, and even the jobs market is showing some preliminary cracks, but not enough yet to really dissuade the Fed from tightening, because inflation is still their primary issue. But the second kind of view that I was holding in tandem was this idea that this turmoil in the first half of the year eventually will lead to something bigger breaking. We just don't know where it's going to happen. These sort of things operate with huge lags. And so for us, I felt like it didn't make sense for the Fed to hike further, that they should have really incorporate these long variable lags and other forms of tightening, like the bank credit channel. They should really incorporate that into their process, and that all this eventually would result in cuts, not necessarily hikes in the second half. But given the resilience of the economy so far, I mean, this is taking much longer to realize. So I think in general, my medium-term view and the framework I've been employing is the right one, but I'm keeping an open mind that it might just take longer to surface, given that we've been dealing with these large lags. But so in short, from a practical standpoint, that means that we do have another hike now expectation, which is basically priced in anyway for the July meeting. But I think beyond that, it's going to get much trickier. We have a long lead time between the July meeting and the September meeting. It's the longest period of the year where the Fed does not have a meeting. We have Jackson Hole in between then, and we get into the sleepy time of the markets, which sometimes can be the most volatile time periods in late August, early September. So I think one hike, and then really think about it. Keep talking tough and hawkish to make sure that your hikes are effective, but they can quickly pivot if something goes wrong.
Yeah, and we certainly saw that from the Fed in March. But yeah, so it sounds like you are sort of maintaining the same view, but you're stretching it out a little bit. So you have another hike. I think if I'm not mistaken, I think you did reduce some of your term rate forecasts a bit further out the curve. But please do correct me if I'm wrong.
That's right.
Okay. All right. So lastly, any forecast would be, just our discussion of a forecast would be incomplete without discussing the risks to that forecast. So what are the risk factors our listeners should be considering, and how would they affect your base case forecast? I guess said another way, what's keeping you up at night, of course, other than your year-old daughter?
So there is maybe one positive kind of risk factor, and I can list a lot more negative risk factors. On the positive side, I mean, I guess perhaps the economy has become more accustomed to these, higher rates, and they're not working as effectively as possible. So the risk is like this idea of, is the transmission mechanism broken? But I'll get to that in a moment. And perhaps that, you get this immaculate disinflation, which everyone talks about. Inflation keeps heading lower, and the Fed can then reverse some of these hikes, and that could, result in a soft landing. We've discussed this in various other podcasts, as well as I've written about it. Soft landings are super rare. Again, not impossible, but given a levered economy as much as the U.S. is, and I don't think the U.S. can decouple from the rest of the world, which is also slowing down. China's been having a difficult time, really getting its economy up and running. Europe is, teetering on recessions, if not some areas are already in recession. That it's going to be hard for the U.S. to decouple if the rest of the world is decelerating. So I still think that eventually these hikes will matter, and we'll end up with a slowdown. But it's also possible that we're now in a less rate sensitive environment, and perhaps it's going to take a lot more, and or the Fed won't have to go as far, and therefore we dodge a recession. I mean, that's obviously a possibility. It's not our base case. And that would be a upside risk for our outlook, which is not what we're factoring in. Conversely, I mean, I think what I'm really concerned about is that the Fed hiked so quickly that that all of this tightening is just going to show up at once. We in the past would have much longer hiking cycles where the economy would kind of like get into it and get accustomed to these level of rates. Perhaps we're still living from the time where there's a lot of stimulus from the fiscal side, and the Fed was very accommodative before it turned hawkish. That that benefit of easing was still in the system, but as we kind of swing the other way, that you're going to get this massive hit from the long and variable lags of all this tightening happening at once. I don't think the transmission mechanism is completely dead. I think it's just lagging. I think policy tightening still works, and it serves a purpose. But in hindsight, I guess what I underestimated was this lingering fiscal stimulus. That the average cost of funding hasn't really reacted or resetted fast enough, given how quickly the Fed hiked. And speaking of risks around like the fiscal outlook, we're not going to get much more fiscal stimulus. There is stuff that or programs that are in place, I should say, that will be with us for like 5-10 years, and part of the IRA, and trying to revamp our infrastructure and things like that are going to be good tailwinds over time, but I don't think they'll be strong enough to overcome what the Fed just did, and also the lack of the big stimulus that happened shortly after COVID. So, and one of like the last kind of relief mechanisms that are in place, which is coming offline, is this student debt repayment, which is going to really feel like a tax hike for many people, which have forgotten about their student payments. And it's going to impact consumer financing and retail sales. So I think like that's still ahead of us for the second half. That's going to be super important. The other bigger picture issues around liquidity and the remaining central bank actions. Again, we think the Fed's going to hike in July. We'll see if they hike another one, but I mean, they're going to at least hang that over the markets until something either breaks or the economy gets weaker. And in the second half, I think the main focus, again, which will be super critical for us, is what the Bank of Japan does with yield curve control. And that in many ways might trump all actions from other central banks if there truly was a material change in the yield curve control. And I guess lastly, coming back full circle to some of the things that have been kind of keeping me up at night, is this idea of the markets perhaps have moved too quickly away from the concerns around the regional banks and generally like the financial system at large. It's a kind of like a catch-22. Like the more the Fed hikes or the more it stays higher for longer, the more likely these banks are going to see rate risks linger, and their bonds that are underwater are even more underwater, and eventually that plus credit concerns in the loan books as well as in commercial real estate, that could surface as well. So like I that in a nutshell, plus dollar liquidity being an issue overseas, I think that could be what upends what has been a good year so far.
Yeah, it sure has. Started trades particularly well, and the economy seems to be holding up pretty well for which has been a big surprise to a lot of people, including myself. Yeah, so it sounds like so it sounds like you highlight some positive risks. The economy maybe works a little bit better than we thought at higher rates, and then we get this sort of immaculate disinflation and the soft landing, although historically unlikely. I really liked, but many more negative risks. I really liked how you put it, that all this tightening shows up at once, not just the Fed, but bank credit conditions tightening, et cetera. I'm sort of sympathetic to that view, but certainly going to be an interesting one. For our listeners, definitely check out MUFG's Foreign Exchange Outlook, which among other things has George's forecast and later thoughts on the U.S. rates market. And again, if you are not receiving George's strategy reports, please do get in contact with George directly. George, thanks so much. Great stuff as always.
Thanks, John. Appreciate it.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.